Imagine a business that didn't sell a single extra product this year. Like its total revenue was completely flat, barely budged a cent from the same quarter last year.
Right, which usually means they're in trouble.
Exactly. By all traditional laws of, corporate physics, that company should be totally treading water. But this particular business somehow walked away with a 55% increase in operating profit.
It's wild.
Yeah, they pulled an extra few $1 billion in profit seemingly out of thin air without bringing a single new dollar through the front door.
It completely defies traditional top-line growth assumptions. We're all conditioned to believe that profitability requires expansion, right? You have to sell more widgets, acquire more customers, or, raise prices.
Right.
But what we are analyzing today is, it's the absolute definition of internal financial engineering and operational leverage. We are looking at a machine that has basically figured out how to extract unprecedented margins from its existing footprint.
And that machine is UnitedHealth Group, ticker symbol UNH. Welcome to today's Talk Tickers Deep Dive. We are tearing into their Q2 2026 earnings call, and the mission here is super straightforward.
Data, story, and actionable takeaways, right?
Exactly. We're going to extract the raw data, dissect the mechanics driving those numbers, and figure out what this actually means for you if you're holding or evaluating this stock. Because on the surface, you have this staggering earnings beat, an aggressive share buyback, and hard proof that AI is actually rewiring healthcare.
Yeah, but when you dig into the transcript, you also find a highly alarming inflation problem hiding in their commercial business. It's not all sunshine.
No, it's really not. Let's jump straight into the raw data to see how those forces actually materialized on the balance sheet. So looking at the headline numbers, the adjusted earnings per share, or EPS, for Q2 2026 came in at $6.38 per share.
And just to put that into perspective for you, in the second quarter of the previous year, that number was $4.08.
Wow.
Yeah, you are looking at a monumental leap in the actual earnings attributed to each share of the company's stock. It completely blew past Wall Street consensus estimates.
But again, this brings us back to the paradox, right? Because total revenues for the quarter were $112 billion.
Which is a colossal amount of money.
Right. It's a massive amount of money flowing through the enterprise. But year over year, that revenue remained largely consistent. It was basically flat.
Yep.
So how does a $112 billion conglomerate functionally increase its operating earnings by 55%, hitting $8 billion without growing its top line? It's like a restaurant that didn't sell a single extra burger this year, but still made 50% more profit just by reorganizing the kitchen.
That is a perfect analogy. That's pure operational efficiency right there.
So we need to look at the specific accounting levers they are pulling, starting with the medical care ratio, or MCR, because I am looking at an MCR of 86.7% for the quarter.
Right, the MCR.
If I remember my insurance basics correctly, this means they are paying out about 86.7 cents of every premium dollar for actual medical care and keeping the rest for administrative costs and profit. Is that right?
That is exactly the fundamental mechanism of the MCR. It basically serves as the core temperature check for a health insurance company's profitability.
Okay.
You want to keep that ratio tightly balanced. If it climbs into the 90s, the company's paying out too much in claims and, bleeding cash.
Bad news.
Right. But if it drops too low, say into the high 70s, federal and state regulators will actually intervene.
Oh, wait, really? They step in?
Oh, yeah. They'll argue the insurer is hoarding premiums and denying too much necessary care. So at 86.7%, UnitedHealth is sitting in a highly profitable yet regulatorily acceptable sweet spot.
But there is a very prominent asterisk attached to that 86.7% in the transcript, because management noted that this figure reflects $860 million of what they call net favorable prior period medical development. That sounds like they are padding their current quarterly grade with extra credit from last semester. Is that a fair assessment?
It is an entirely fair assessment, honestly. And understanding the mechanics of prior period development is just crucial for any investor reading these earnings reports.
Break it down for us.
So, when a healthcare company closes its books at the end of a quarter, it operates in a state of partial blindness. They just do not have all the bills yet.
Because the healthcare billing system is so incredibly slow.
Exactly. Say a patient visits a specialist in June. The hospital's billing department processes the paperwork in July, and the insurer might not actually finalize the payment until August.
Right, that makes sense.
So at the end of June, the insurer's actuaries have to estimate how much they think they are going to owe for all those outstanding June visits, and they set that cash aside in a reserve account.
It's essentially a corporate-scale, educated guess based on historical claims data.
Precisely. Prior period development happens when the company looks back at those older reserve estimates and realizes, hey, our guess was actually too high. The actual bills that eventually came in were lower than we anticipated.
Oh, I see. It's like setting aside $10,000 for a looming corporate tax bill, only to have your accountant call a few months later to say, hey, you only owe $9,000.
Yes.
That extra $1,000 instantly drops to your bottom line for the current quarter, even though the economic activity that generated it technically occurred in the past.
That is the perfect analogy.
Yeah.
And in UnitedHealth's case, that accountant found $860 million.
That is a lot of extra cash.
Right. So when that reserve cash gets freed up, it flows directly back into the current quarter's earnings as a favorable adjustment. And that artificially lowers the reported MCR.
Okay, so the 86.7 is a little inflated by that.
Well, management did explicitly state that the majority of this was in-year development, meaning it relates to claims from the first quarter of 2026, not ancient history. But it still signifies that the MCR is heavily aided by a look-back adjustment, not just pure operational execution in Q2.
Which brings up another highly technical but incredibly revealing metric they dropped on the call. Days claims payable, or DCP.
Oh, the treasury magic.
Yeah, they reported a DCP of 47 days, and the transcript notes this is an increase of roughly 2.5 days from the previous year. Now, on a human scale, paying a bill 2 days late is meaningless.
Right, nobody cares.
But at this scale, what is the actual financial utility of holding on to cash for an extra 48 to 60 hours?
It is a phenomenal treasury strategy, honestly. Days claims payable estimates the average number of days it takes for the insurance company to pay its outstanding approved claims to doctors and hospital networks.
Okay.
When you are processing tens of billions of dollars in claims, holding onto that capital for an extra 2.5 days is a staggering financial lever.
Because of interest rates.
Exactly. We are operating in an economic environment where interest rates are a significant factor. Holding billions in cash for a few extra days allows the company's treasury department to earn substantial interest on that float.
They are essentially acting like a bank, monetizing the delay between authorization and actual payment.
Precisely.
Yeah.
It strengthens their liquidity and generates passive interest income. Now, it certainly frustrates the hospital systems and private practices who want their capital faster, obviously.
Yeah, I bet they hate it.
They really do. But from a purely fiduciary perspective for UnitedHealth's shareholders, extending the DCP is a brilliant method of squeezing extra yield out of the operational pipeline.
And that strategy clearly feeds into the cash generation figures, which are almost hard to fathom. The operating cash flow for the quarter was reported at $11 billion.
Yeah, massive.
That operating cash flow is 1.9 times their net income. How does a company's actual cash generation outpace its accounting profit by nearly double?
Well, the disparity between accounting net income and operating cash flow usually comes down to the timing of capital inflows, particularly government payments.
Okay, so Medicare and Medicaid stuff.
Exactly. UnitedHealth Group is heavily entrenched in Medicare and Medicaid. This means they rely on scheduled, colossal cash infusions from the federal government and various state treasuries.
Right.
So depending on the exact calendar day the quarter ends, relative to when those government wires actually clear their accounts, the raw cash flow can spike significantly higher than the recognized accounting profit for that specific 90-day window.
Okay, so synthesizing all this headline data for you, we have a company with flat top-line revenue, but skyrocketing earnings fueled by a combination of favorable past claim estimates dropping to the bottom line, aggressive treasury management extending payment delays to earn interest, and a mountain of government cash clearing their accounts.
That's a great summary.
But this sets up the critical question for our analysis, because we know what happened on the balance sheet. Now we need to look under the hood and understand how they are achieving this efficiency at a structural level. Because it's not just financial tricks, right?
No, not at all. To understand the how, we really have to pivot our attention to their Optum division. Specifically, we need to analyze how they are aggressively deploying artificial intelligence.
AI. The buzzword of the decade.
Right, and it is vital to separate the hype from the reality here. Across corporate America, AI has just become a mandatory buzzword injected into every earnings call to appease algorithms and analysts.
Everyone is an AI company now.
Exactly. But UnitedHealth Group is presenting hard, quantifiable return on investment. They're not talking about chatbots on a website. They are talking about algorithmic infrastructure.
Yeah. CEO Stephen Hemsley's language on the call was super aggressive. He stated they are actively and appropriately embracing an AI paradigm to literally reimagine the entire enterprise.
That's a bold claim.
Let's drill into the specific use cases they highlighted, starting with the clinical side. Patrick Conway, who leads Optum Health, noted that their AI-based ambient listening technology is now available to 70% of their employed providers. And they have a target of hitting 90% by year-end.
Which is incredibly fast adoption.
I need you to walk me through the actual mechanics of this. How does an AI sitting in an exam room translate into operational efficiency for an insurance conglomerate?
Well, the mechanism of ambient listening completely alters the traditional clinical workflow. Historically, a physician spends a significant portion of an exam acting as a data entry clerk.
Yeah, always staring at a screen.
Exactly. They're staring at a laptop, typing furiously, trying to force the patient's complex narrative into the rigid, structured fields of an electronic health record, or EHR.
Which doctors hate.
They despise it. It creates the infamous cognitive burnout that plagues the medical profession. Doctors are spending hours after their shifts, what the industry actually calls pajama time, just finishing administrative documentation.
So the ambient listening tool basically replaces the keyboard.
It goes much deeper than simple dictation, honestly. The AI securely listens to the natural conversation between the doctor and the patient. Using advanced natural language processing, it doesn't just transcribe, it analyzes the context.
Okay, give me an example.
Sure. It understands that when a patient says, my chest feels tight when I walk upstairs, that translates to specific medical terminology and billing codes. The algorithm automatically categorizes the symptoms, formulates the clinical note, and suggests the appropriate ICD-10 diagnostic codes directly into the patient's file in real time.
Wow. And the transcript cites a 90% reduction in cognitive burnout for clinicians using this tool. That is just an astonishing figure.
It is a total paradigm shift. If you eliminate 3 hours of nightly data entry for a clinician, the operational leverage is profound.
Because they can see more patients?
Exactly. Yeah. The physician is less fatigued, less prone to diagnostic error, and fundamentally, they have the bandwidth to see more patients per day without compromising the quality of the interaction.
And that throughput directly fuels the 55% increase in operating profit we discussed earlier.
Precisely. This is how a healthcare company expands patient access and increases clinical throughput without having to hire a proportional, wildly expensive number of new doctors.
But the clinical side is only half the equation, right? Because the administrative friction in healthcare is arguably a bigger drain on capital, specifically the prior authorization process.
Oh, absolutely.
Anyone who has interacted with the American healthcare system knows this pain point. A doctor prescribes an MRI or a specialty medication, but the insurance company demands a review before they agree to pay for it.
It's a nightmare for everyone involved.
It traditionally involves fax machines, hold times, and peer-to-peer phone calls between frustrated doctors and insurance adjusters.
Yeah, it is universally despised by providers and patients alike. And it requires a massive army of administrators on the insurance side just to process all that paperwork.
But UnitedHealth Group stated they are using AI to power digital prior authorizations now. And the success rate they reported is staggering. They are achieving a 96% first-pass approval rate.
That number is huge.
How does an algorithm make a medical necessity determination that quickly?
Well, the AI is essentially a highly complex decision tree overlaying the company's clinical policy guidelines.
Okay.
When a provider submits a request for an MRI, the algorithm instantaneously cross-references the patient's digital chart, their symptoms, previous concerted treatments like physical therapy, their lab results, against the exact criteria required for MRI approval.
And if it matches?
If all the variables match, the AI issues an instant approval. Done.
But what about the 4% of cases that don't match? Because there has to be a massive regulatory and liability risk if an AI starts indiscriminately denying care to patients.
Oh, definitely. And that is the critical safeguard management emphasized on the call. The algorithm is currently optimized for approval, not denial.
Okay, that's a big distinction.
Very big. If a service does not clearly meet the criteria for algorithmic authorization, the system does not issue a denial. Instead, it routes the case to a human clinician for a comprehensive manual review.
So the AI is just taking out the trash, so to speak, handling the easy stuff.
Exactly. It serves as a high-speed filtration system. It instantly clears the obvious legitimate requests, which removes the bottleneck and frees up the human clinical staff to focus solely on the complex edge case files.
And the raw math on the time saved is impressive. They reported saving 69,000 administrative hours just from this specific application.
69,000 hours. It's incredible.
And they are so confident in the underlying technology that they committed to eliminating 30% of their total prior authorization volume by the end of 2026. I mean, this isn't just trimming the fat. This is fundamentally restructuring how they manage medical utilization.
And this technological efficiency is deeply intertwined with a structural shift in how they deliver care, which brings us to their aggressive push into the value-based care model under Optum Health.
Right, value-based care.
To understand why this is driving their margins, you really have to understand the financial friction it creates compared to the legacy system.
The legacy system being fee-for-service.
Exactly.
Because under that model, a hospital or a doctor is financially incentivized by volume. They get paid for every single MRI, every blood test, every day a patient stays in a hospital bed.
Correct. The fee-for-service model creates a direct misalignment between the provider's financial health and the patient's physical health.
Yeah, because if a patient gets sick and needs a triple bypass surgery, the hospital generates immense revenue.
But value-based care attempts to totally invert that paradigm.
So how does the financial mechanism of value-based care actually work on the ground?
So in a fully capitated value-based arrangement, an insurance company like UnitedHealth goes to a provider network and says, hey, we will pay you a fixed upfront sum of money per month to manage the total health of this specific population of patients.
Just a flat fee.
Yep. If the provider can keep those patients healthy, proactively manage their diabetes, ensure they take their preventative medications, and keep them out of the emergency room, the provider actually gets to keep a portion of the unspent budget as profit.
Okay, so the financial incentive shifts from performing expensive interventions to preventing the need for interventions in the first place.
Exactly. Keep them healthy, you make more money.
But that has to create massive friction, because if I am a hospital administrator, my entire operating budget relies on my beds being full and my MRI machines running 24/7. Now UnitedHealth is actively trying to empty my beds.
Oh, it creates intense friction with legacy hospital systems, which is exactly why UnitedHealth has spent the last decade simply buying up independent physician groups and building their own clinics under Optum Health.
They are just bypassing the hospitals entirely.
They are. And the data from the call prove the model is working. They highlighted that Optum Health's enhanced care transition support resulted in a 10% reduction in hospitalizations since its implementation late last year in their western and southern regions.
A 10% reduction in hospitalizations is a monumental figure. A single inpatient admission can cost an insurer tens of thousands of dollars. Multiplying that by a 10% reduction across massive geographical regions, that represents hundreds of millions in avoided costs.
It really does. And they also pointed to pilots in home health initiatives that drove a more than 20% improvement in timely care delivery, alongside noticeably shorter lengths of stay when patients did require admission to skilled nursing facilities.
They are really pushing care out of the hospital.
Yeah, they even cited conducting 2.5 million rural patient home visits, reaching nearly 90% of U.S. counties. They are utilizing analytics to identify the highest risk patients and deploying clinicians directly into their living rooms.
All to prevent the catastrophic high-cost medical events before they happen. Okay, so on the Optum side, we see this dual engine driving profitability. You have AI algorithms stripping out the administrative bloat and value-based care models stripping out the clinical waste.
It's a powerful combination.
But this brings us to the bearish headwind blowing through this earnings call. Because for all the success in their medical provision and technology divisions, their commercial insurance segment, which is the core business of providing health benefits to employers, is flashing bright red warning signs.
Oh, yeah. The specific data point management delivered was jarring.
What was it?
They stated that their commercial cost trend is running uncomfortably high, modestly above 11%.
Yikes. So the sheer cost of paying for medical care for their commercial members is inflating by more than 11% year over year.
Yes. And in a business built on tightly managed actuarial margins, an 11% inflation rate is catastrophic.
I mean, they cited a few expected drivers, like the explosion in utilization for GLP-1 weight loss medications, which we all know are incredibly expensive.
Right, Ozempic and all of those.
But the most prominent and frankly the most baffling driver they called out was something termed the independent dispute resolution process, or IDR.
Ah, the IDR process.
I need you to unpack the legislative history here, because this appears to be a classic case of a well-intentioned law backfiring spectacularly. I am totally puzzled by this. How is a law meant to protect patients driving up costs?
It is a textbook example of unintended consequences within a complex regulatory environment. So the IDR process was birthed from the No Surprises Act, which was a federal law passed with a very clear pro-consumer intent.
Right. Nobody likes surprise bills.
Exactly. For years, patients were falling victim to surprise medical billing. You might meticulously ensure that your local hospital is in network for an upcoming surgery.
You do all your homework.
You do. But while you are unconscious on the operating table, the hospital brings in an anesthesiologist who happens to be an independent contractor and is out of network with your specific insurance plan.
And weeks later, the patient checks their mail and finds a $5,000 balance bill from a doctor they never even met, just because the insurance company refused to cover the out-of-network rate.
Exactly. The No Surprises Act rightfully made that practice illegal.
Good.
The law dictates that the patient is removed from the crossfire. They're only responsible for their standard in-network copay or deductible, so the consumer is protected.
But let me guess, the underlying financial conflict didn't disappear.
Nope, it just shifted. The out-of-network provider still expects to be paid their premium rate, and the insurance company still insists on paying a lower reasonable rate.
So the law mandated a mechanism to resolve that standoff between the provider and the insurer.
Yes. The government established the Independent Dispute Resolution, or IDR, process. It is a mandatory arbitration system.
Okay, so they go to arbitration. But according to the UnitedHealth executives on this call, that arbitration system is fundamentally broken and actively being exploited. Dan Kueter, a UHG executive, provided some highly specific data on how providers are gaming this system.
To understand the exploitation, you really have to understand the mechanics of the arbitration itself. It operates on a baseball arbitration model.
Baseball arbitration?
Yeah, so the insurance company submits the monetary figure they believe is fair. The provider submits the figure they desire. The independent arbiter is not allowed to split the difference or negotiate. They must select one of the two submitted numbers.
Wait, really? They just pick one or the other?
Yep, no middle ground.
So if a private equity-backed provider group believes they have a sympathetic arbiter, or if they recognize a pattern in the arbiter's decisions, they are heavily incentivized to submit astronomically high numbers, knowing there is no penalty for aiming high if they win.
Precisely. And Kueter's data eliminated the scale of this behavior. First, he noted the sheer volume of claims being pushed into arbitration is paralyzing the system, to the point where upwards of 40% of all claims entering the IDR process are ultimately deemed ineligible upon review.
40%.
Providers are utilizing algorithmic billing software to automatically trigger arbitration on virtually every disputed claim, regardless of merit, simply to clog the administrative pipes and force settlements.
That is insane. It is a brute force denial of service attack on the arbitration infrastructure.
It really is.
Yeah.
But the most alarming statistic Kueter revealed was regarding who is actually filing these disputes. He stated that roughly 60% of all arbitration cases nationwide are being brought by just 5 specific entities.
Wait, 5? Just 5 entities?
Let that sink in. A federal law designed to protect consumers across the entire nation has been co-opted by 5 highly concentrated, likely private equity-backed provider groups or staffing firms.
That is wild. They are not using arbitration as a mechanism of last resort to resolve genuine disagreements. They have weaponized the IDR process, integrating it into their core revenue strategy.
Exactly.
And what happens when these specific provider groups actually win their arbitration cases? Like, what kind of financial damage are we talking about here?
The payouts are staggering, honestly. Kueter revealed that when arbiters side with the out-of-network providers in these disputes, the mandated payouts are averaging 11 times the standard Medicare rate.
11 times.
And in certain geographies and specialties, they are seeing arbiters award payouts that range up to 30 times what Medicare would pay for the exact same medical service.
An 11 to 30x multiple on the Medicare rate. So if the standard benchmark for a procedure is $500, these arbiters are legally forcing UnitedHealth to pay $5,500 for that single intervention.
Yep.
I mean, an insurance company cannot just absorb that kind of asymmetric loss indefinitely.
They cannot. That excessive cost ultimately gets passed directly back into the economy. in the form of higher insurance premiums for employers, which depresses wage growth for employees.
It's a vicious cycle.
And management explicitly quantified the damage. They stated that this exploitation of the IDR process is actively adding 50 to 100 basis points, so between 0.5% and 1%, to their total commercial medical cost trend.
When you are managing a commercial risk pool worth tens of billions of dollars, 100 basis points of artificial inflation is a massive systemic leak.
Massive. And on top of the arbitration mess, they noted that providers across the board are getting increasingly aggressive with their everyday billing practices. They specifically called out higher coding intensity.
Right, let's translate that for you guys listening. Higher coding intensity. What does that mean in plain language?
So coding intensity refers to the complex system of evaluation and management, or E&M, codes that providers use to bill insurers for office visits. The codes represent the complexity and duration of the interaction.
Okay, give me an example of the levels.
A level 2 code represents a quick, simple consultation for a minor issue, say a 10-minute check on a mild rash. It pays a modest fee. A level 5 code represents a highly complex visit requiring extensive medical decision-making, perhaps for a patient with multiple uncontrolled chronic conditions. And obviously, level 5 pays significantly more.
So higher coding intensity means that doctors, or more accurately, the revenue cycle management software utilized by hospital systems, are systematically shifting their billing patterns upward.
Exactly.
They are increasingly submitting level 4 or level 5 codes for interactions that historically would have been billed at a level 2 or 3.
Yep. It is a subtle but pervasive form of upcoding. Now, providers will argue that patient acuity, how sick people are, is genuinely increasing, justifying the higher codes.
Sure, people are getting older and sicker.
But insurers argue it is simply margin optimization by hospital billing departments, pushing the boundaries of the coding guidelines to maximize revenue within the fee-for-service structure.
So the combination of these two forces, the weaponization of the arbitration process and the aggressive upcoding by providers, forced a rare admission of defeat from UnitedHealth management regarding their timeline.
It did.
They originally projected that their commercial profit margins would fully recover and begin expanding in 2026. But on this call, they explicitly conceded that this sticky, elevated inflation trend is extending the time frame for full margin recovery past 2027.
It is a significant delay. And in the equity markets, delayed margin expansion is usually punished severely.
Which brings us to the most critical phase of our analysis, management guidance. We have established that the Optum and AI divisions are operating with lethal efficiency, while the commercial insurance side is bleeding from 11% inflation.
Two massive forces colliding.
Exactly. So the question for Wall Street is, which force is stronger? How is management reacting to these colliding variables for the remainder of 2026 and beyond?
Well, this is where the sheer scale and diversification of UnitedHealth Group insulate them from regional or segment-specific shocks. Despite that glaring commercial cost trend and the delay in margin recovery, management did not lower their expectations.
They actually raised them.
In fact, they raised their overall financial guidance for the year.
Let's look at the specific revised projections. They provided a new, elevated, adjusted EPS guidance range of $19.50 to $20 for the full year 2026.
Right. And this upward revision reflects a profound confidence in their internal modeling. They're explicitly signaling to the market that the hundreds of millions of dollars in efficiencies generated by the Optum AI deployments, combined with their disciplined risk management in other segments, are robust enough to entirely offset the financial drag of the commercial arbitration exploitation.
That is a bold signal. Drilling down into the specific segments, they bumped up the full-year operating earnings outlook for UnitedHealthcare, which is the traditional benefits and insurance side, to at least $12 billion.
And for Optum Health, the care delivery and technology side, they raised expectations to at least $2.2 billion.
Nice.
It's also vital to look at how they are projecting the medical care ratio for the rest of the year, because they guided toward a full-year MCR of 88.1%, plus or minus 25 basis points.
Now, wait a minute. We just discussed that their Q2 reported MCR was 86.7%. So they are projecting that the ratio is going to climb higher in the back half of the year.
Yes, they are. And that is a normalized, expected seasonal pattern.
Because people use more healthcare at the end of the year.
Exactly. The second half of the year typically sees higher medical utilization as patients hit their annual deductibles and rush to schedule elective procedures before the calendar resets.
Ah, right. Get that knee surgery in December.
Plus, management is tacitly acknowledging that they cannot rely on finding another $860 million in favorable prior period development every single quarter.
Lightning doesn't strike twice.
Right. So they are setting a realistic, normalized expectation for the underlying medical costs, factoring in that persistent commercial inflation.
But the financial maneuver that really caught my attention on this call, the ultimate corporate flex revolves around their capital deployment strategy.
Oh, the buybacks.
Yes. During this quarter, while actively battling this 11% cost inflation, they deployed $4 billion in cash to repurchase 11.4 million of their own shares off the open market.
A huge move.
And they did not stop there. They announced they are doubling their target for full-year share repurchases, raising it from their initial guidance of $2.5 billion up to at least $5 billion.
It is an incredibly aggressive capital allocation decision.
I really want to focus on the signaling theory here for a second. Why does a management team double its share buyback target mid-year, funneling $5 billion into its own stock, while simultaneously admitting that margins in one of its core businesses are severely delayed?
What's your read on it?
To me, this enthusiastically points out that the executive suite fundamentally believes the market is mispricing their stock. They are looking at that $11 billion in operating cash flow we discussed earlier, looking at the current share price, and deciding that the absolute highest yielding investment they can make is betting on themselves.
You are interpreting the signal correctly. The mechanics of a share buyback are straightforward. By purchasing their own stock and retiring those shares, they reduce the total number of outstanding shares on the market,
which makes the remaining slices of the pie bigger.
Consequently, the company's future net earnings are divided among a smaller number of shares, which mechanically boosts the earnings per share, or EPS metrics. It is a highly efficient method of returning value to the remaining shareholders and artificially supporting the stock price.
But it's risky if you don't have the cash.
Exactly. It is a strategy that only functions sustainably if a company possesses immense, durable, recurring cash flow and unshakable confidence in their long-term operational trajectory. If they doubted their ability to weather the commercial inflation storm, they would be hoarding that cash on the balance sheet, not destroying it to buy back equity.
And they compounded that bullish signal by simultaneously announcing a dividend increase. The board of directors approved raising the dividend to $9.28 per share on an annualized basis. So they are returning capital through both primary mechanisms, buybacks, and dividends simultaneously.
Which is exactly why Wayne DeVate, on the earnings call, went out of his way to highlight the health of their balance sheet. He emphasized that their debt-to-capital ratio improved to 41.2%, representing a 170 basis point sequential improvement.
So let me get this straight. They are aggressively paying down corporate debt, actively raising the dividend yield, and doubling the velocity of their stock buybacks all at the same time.
It demonstrates a fortress balance sheet. They are generating so much operational cash flow that they can execute all three capital distribution strategies without compromising their ability to fund internal R&D or pursue future acquisitions.
That is just wild. All right, let's shift our focus to the guidance surrounding Medicare Advantage, because the strategic dynamic playing out in this segment is utterly fascinating to me.
It's a really interesting case study in margin management.
For context, Medicare Advantage, or MA, is the privatized alternative to traditional government-run Medicare. Seniors opt into these plans, and the government pays companies like UnitedHealth a capitated rate to manage their care.
Correct.
On the call, management projected that their MA enrollment is expected to decline by approximately 1.1 million members for the full year.
Right. And on the surface, losing over 1 million covered lives sounds like a catastrophic market share failure.
Exactly. If any traditional business lost 1 million recurring customers in a 12-month window, Wall Street would trigger a massive sell-off. But here is the paradox. In the same breath, management projected that their Medicare Advantage margins will finish 2026 above 3%.
Yes.
They are voluntarily shedding a massive amount of volume, yet maintaining highly resilient profitability. I really need you to explain the actuarial math behind how you can lose 1 million customers and still protect a 3% margin.
It requires a deep dive into the concept of adverse selection and benefit curation.
Okay, let's do it.
So, over the past few years, the Medicare Advantage market became hyper-competitive. Insurers were engaged in an arms race, basically trying to capture market share by offering increasingly lavish supplemental benefits.
Oh yeah, you see the commercials all the time. $0 premiums, extensive dental and vision coverage,
free gym memberships, and even prepaid debit cards for groceries.
They were using aggressive marketing and unsustainable perks to lure seniors away from traditional Medicare.
Precisely. But as overall medical utilization increased post-pandemic, and as government reimbursement rates tightened, offering those lavish benefits became margin-crushing. Insurers found themselves holding massive populations of seniors who were utilizing the expensive benefits at a rate that mathematically outpaced the government subsidies.
So they were losing money on these members.
Hand over fist. So UnitedHealth Group recognized the math was breaking, made a ruthless strategic choice.
What did they do?
They essentially dictated, we will not engage in a race to the bottom. We are going to price our Medicare Advantage products to ensure strict actuarial profitability, even if it means our benefit packages are no longer the absolute flashiest on the market.
So they intentionally reduced the generosity of their supplemental benefits in specific high-cost geographies.
Yep.
They intentionally made their products less attractive to a specific cohort of consumers.
Exactly. They actively curated their risk pool. They recognized that a certain percentage of members, often the ones highly sensitive to supplemental benefit changes who frequently switch plans, were inherently unprofitable to manage under the current reimbursement environment.
So let the other guys take the loss.
Basically, yes.
Yeah.
By adjusting the benefits and selectively altering their market participation, they allowed competitors to absorb those unprofitable members. So yes, they're serving 1.1 million fewer seniors, but the population they retained is highly stable and generating a sustainable above 3% margin.
That is the epitome of disciplined operational management. Prioritizing margin over volume requires immense restraint, especially when your competitors are aggressively chasing top-line growth.
It really does. However, management did acknowledge a significant looming headwind in the Medicare segment regarding star ratings.
Star ratings. Let's break down what star ratings are and why a downgrade represents an existential threat to that 3% margin.
So the Centers for Medicare and Medicaid Services, or CMS, the federal agency that oversees the program, rates every Medicare Advantage plan on a 1 to 5-star scale.
Okay.
This rating is an aggregate score based on dozens of complex metrics. It ranges from clinical outcomes like cancer screening rates and diabetes management, all the way to customer service metrics like call center hold times and member complaint volumes.
It functions like a Yelp review system, but with massive financial consequences attached.
The financial consequences dictate the entire industry, honestly. If an insurer achieves a 4-star or 5-star rating on a plan, CMS awards them substantial quality bonus payments.
Like how much?
We are talking about hundreds of millions, sometimes billions of dollars in sheer bonus revenue. And more importantly, those highly rated plans are permitted to use that bonus money to fund extra supplemental benefits for their members.
Which creates a virtuous cycle that attracts even more enrollment.
Exactly. But if a plan drops below 4 stars, it loses the bonus money, it is forced to cut benefits, and it enters a death spiral of declining enrollment and shrinking margins.
And the transcript noted that the entire industry is facing a crisis regarding these ratings. Management stated that the 2026 industry star scores are at their lowest aggregate level in a decade.
Yeah, CMS has fundamentally changed the grading curve. They have implemented new statistical methodologies and drastically raised the thresholds required to achieve a top rating.
Making it harder to get an A.
They are making the test significantly harder to pass, effectively attempting to claw back billions of dollars in bonus payments to save the government money. Management acknowledged this systemic challenge, noting the flurry of lawsuits currently sweeping the industry as insurers attempt to sue the government over the methodology changes. However, UnitedHealth committed to continuing massive internal investments in their quality and clinical engagement programs to aggressively defend their ratings in the coming years.
Okay, so while Medicare is a battleground of margins and ratings, we also need to briefly touch on Medicaid, the state-federal partnership program that provides health insurance for low-income individuals.
Right, Medicaid.
Because the guidance here was notably pessimistic.
Yes, the Medicaid segment is facing acute pressure. Management projected that their Medicaid margins will remain compressed between -1% and -1.7% for the full year 2026.
That's negative margin. So they are actively losing money on their Medicaid population.
They are operating at a slight loss in that specific segment, yes.
Why?
Well, the core issue in Medicaid is a fundamental mismatch in temporal mechanics. Medical costs, the price of drugs, hospital stays, and physician labor are inflating in real time.
Mm-hmm.
However, the premium rates that UnitedHealth receives are dictated by state governments, and state legislatures operate on painfully slow annual budgeting cycles.
Ah, the bureaucracy cannot move fast enough to match the inflation.
Exactly. Management noted they're expecting rate increases of around 6% to 7% from various state governments this year. And in a vacuum, a 7% rate increase sounds healthy.
But when the underlying medical cost trend is running higher than that,
The insurer is left bridging the gap with their own capital. They're actively negotiating with state actuaries, attempting to implement localized fraud reduction initiatives and tighter network curation. But until the state reimbursement cycles catch up to the reality of medical inflation, the Medicaid segment will remain a persistent drag on overall profitability.
okay, let's zoom out from the segment specifics and look at the most critical piece of forward-looking guidance provided on the call. An analyst specifically pressed CEO Stephen Hemsley on the company's long-term trajectory, given the chaotic regulatory and inflationary environment.
And Hensley's answer was very direct.
Very direct. He definitively reaffirmed the company's long-term annual earnings growth target of 13% to 16%.
That 13 to 16% figure is the holy grail for this stock. It is the core algorithm that dictates their valuation multiple.
It's what everyone is watching.
They are looking Wall Street directly in the eye and stating that despite the weaponization of the IDR arbitration process, despite actively losing money in Medicaid, despite shedding over 1 million members in Medicare Advantage, and despite the tightening of star ratings, they have the levers to reliably grow their bottom line earnings by 13 to 16% every single year, compoundingly over the long haul.
And Hemsley specifically cited their technology-driven productivity gains, namely the aggressive scaling of the AI infrastructure we discussed earlier, as the primary engine that will guarantee that growth algorithm remains intact.
It's all resting on the AI.
Which seamlessly brings us to our final synthesis. We've dissected the balance sheet, we have analyzed the mechanics of AI implementation and arbitration exploitation, and we have stress-tested their forward guidance. Now, what does this actually mean for you, the listener?
The bottom line.
Exactly. If you are a retail investor analyzing this specific ticker, what is the actionable conclusion?
Well, from a purely analytical investment standpoint, parsing the subtext of this transcript leads to a decidedly bullish stance on UnitedHealth Group.
You're bullish.
I am. Now, you have to acknowledge the reality of the commercial headwinds. The delay in commercial margin recovery past 2027 is frustrating. The IDR arbitration process is clearly fundamentally broken and requires an act of Congress to repair, which introduces significant legislative uncertainty.
But the core thesis remains intact.
The thesis is more than intact. It is strengthened by how they navigate the adversity. The sheer magnitude of their operational efficiencies, driven by the AI deployment and the value-based care transition within Optum, is provably capable of absorbing and offsetting massive systemic shocks.
Yeah, the numbers don't lie.
When a conglomerate can generate a 55% increase in operating earnings on totally flat revenue, they've engineered an incredibly resilient financial machine.
And I think the strategic discipline they demonstrated in the Medicare Advantage segment is the perfect encapsulation of that resilience. They refused to chase unprofitable top-line growth. They absorbed the headline shock of losing 1 million members because they possess the actuarial confidence to prioritize a sustainable 3% plus margin.
Exactly. For the retail investor analyzing their portfolio, UnitedHealth Group continues to flash a stronghold or buy signal, dependent entirely on your specific entry point and valuation methodology, of course.
Right.
But their cash generation is elite. $11 billion in a single quarter provides unparalleled optionality. They're aggressively returning that capital to shareholders via a doubled $5 billion buyback authorization and an increased $9.28 dividend.
Returning value right back to you.
And management has definitively planted their flag on the 13 to 16% long-term growth algorithm. This is not a speculative high-beta tech play. This is a highly durable cornerstone equity for a long-term portfolio, managed by an executive team that fundamentally understands how to navigate turbulent, hostile regulatory waters and extract margin from inefficiency.
It is a corporate battleship. It just keeps grinding forward completely, regardless of the chop in the water.
That's a good way to put it.
We have covered a tremendous amount of ground today, analyzing how UnitedHealth is aggressively deploying AI-like ambient clinical listening and digital prior authorizations to strip millions of hours of administrative waste out of their own internal operations. But before we wrap, if you connect the dots buried in the transcript, there's one final profound implication that fundamentally alters how we should view this company's future.
Oh, this is a subtle detail, but the implications are staggering.
Sandeep, one of the executives leading their data and analytics division, Optum, casually noted that roughly a third of their total AI investments this year are explicitly focused on converting their internal use cases into commercialized external products.
They aren't just building these tools for themselves.
No. They launched a product suite called Value Connect, an AI-driven insights platform. They reported that early external clients utilizing this platform saw a 17% reduction in pharmacy costs.
And that digital prior authorization algorithm we spent so much time analyzing earlier, the one driving a 96% first pass approval rate and saving UnitedHealth 69,000 hours.
Yeah.
They have actively packaged that specific algorithm into a commercial software as a service product under the Optum Real family.
Wait, really?
Yes. Sandeep confirmed that year to date, this commercially sold AI has already processed approximately 500,000 prior authorizations for external entities.
Meaning they're selling their proprietary efficiency algorithms to other insurance companies and independent hospital systems outside of the UnitedHealth umbrella.
Think about the gravity of that pivot.
It's massive. They spend billions building an AI infrastructure to repair their own fundamentally flawed operational house. But now they are actively selling the architectural blueprints and the robotic construction crews to the entire neighborhood.
It completely disrupts the traditional industry classification. If Optum Insight successfully scales this commercialization, they are no longer just an internal analytics division for an insurer. They transition into an enterprise SaaS vendor, providing the core operating system for the broader American healthcare ecosystem.
Wait a minute. If they are packaging this AI and selling it to their own competitors, they aren't just cutting costs anymore. Are we currently valuing a rapidly scaling enterprise software company as if it were just a traditional slow growth insurance provider?
That's the question you have to ask. If that revenue mix shifts, you're looking at a potential multiple expansion that the market has not yet priced in.
It requires a total recalibration of the valuation models. When you look at the surface level X-ray of this company, you expect to see the traditional predictable anatomy of an insurance conglomerate, collecting premiums, managing actuarial risk, and paying claims.
Right.
But when you apply the MRI of this earnings transcript, the underlying diagnostic landscape is entirely different. You are witnessing a technology and care delivery engine that is systematically rewiring its own structural anatomy to generate explosive profit without relying on top-line premium growth.
It is a phenomenal evolution to witness in real time.
It really is. Thank you for joining us on this Talk Tickers deep dive. We hope this exhaustive analysis provided the context required to truly understand the complex mechanics operating beneath the headline numbers. Keep analyzing the data, keep questioning the consensus narrative, and we will catch you on the next deep dive.